Good day and welcome to another Bond Buyer podcast. This is John Hallacy, your host today. And with me is William Cox, a managing director of Kroll Bond Rating Agency. Bill brings over 20 years of experience in credit ratings. He's been at Kroll for some time now and previously had been at S&P, and he's been around the industry for quite some time. Welcome, Bill.
Thank you, John. Good to be here.
And today's topic is recently Bill had authored a pension liability discussion on the city of Chicago. And this is sort of a new embarkation point for Kroll in terms of taking a different look at the pension funding scenarios that are out there. And I think what the emphasis has been in the report is primarily on affordability and sort of linking the affordability aspect on pensions along with debt and kind of taking a holistic view, if you will. What was the genesis for this, Bill?
That's a great question, John. I think for some time that the team at Kroll, led by Karen Daly, believe that the pension issue, not just in Chicago, but in other places, needs a deeper look than just looking at the balance sheet ratios. And the question that Karen and others were challenging each other with is what is the ability ultimately to afford the pension obligation on an annual basis, as opposed to stopping at the point where the ratio on the balance sheet looks particularly good or bad. And that's really the start. And then the question was, well, how do you go about analyzing quantitatively and qualitatively the issue of affordability in a deeper way than just looking at an income ratio?
Well, of course, being a good credit analyst that I am, I'll bring you right back to the ratios. So,
Great.
Essentially, the main plan in Chicago, according to your figure 5 here, is 29.5% funded.
Right.
And I know that's a static figure, and that's kind of what you're saying. We need to get away from just taking the snapshot and taking a more dynamic approach, if you will.
Right. I'd say that there's no question that ratio is troubling, and it's a ratio that got to that level after years of neglect by some combination of the state officials and the prior city officials, and of course the downturn in the economy and 2 major downturns in the markets. It was almost a conspiracy of no one. Mm-hmm. And I think the current administration has done a good job of at least focusing on this issue and starting on a path to correction. But yes, the ratio is what it is. The question we asked, now what?
Where do we go from here?
Where do we go from here? And that was really the starting point. There's no arguing about the ratio being bad. It's, can they afford to do what's necessary next?
Right. Well, let me ask a different question. Classically trained analysts are kind of taught that debt in and of itself is not a strong rating factor in terms of being predictive of outcome. Is pension becoming more so?
I would think it depends on the situation and the city. Certainly if it's in combination with debt that's too high, or in combination with an economy that's lost its ability to generate revenue, then in combination I would agree that it has an issue in and of itself, and I think Chicago is a good example. It's certainly creating pain on the budget, and will do so for many years to come. But at the end of the day, the economy is so deep and so wide and has so many diverse sources for the city to draw from that we believe that the pension liability issue in and of itself is affordable.
Well, clearly the economy is in pretty good shape. There have been some recent articles about development in brownfields, old industrial sites that they're now developing along waterways and such. It sounds like the growth is really taking off there. Again, just to circle back to some of the assumptions, I think recently the plans adopted a change in the investment return assumptions down to 6.5%.
I think some of the plans have come down a bit. Each plan makes its own decision.
Right.
But I don't believe they're all at 6.5% yet.
Right. But certainly that aggravates some of that unfunded ratio number too.
Sure. Well, the assumptions that are used by the actuary, and obviously if the city's funds decide that they're going to assume 6.5% going forward, the way the new and much better state pension legislation works is then that would require the city to increase its contributions.
Right.
In the past, that wasn't the case. It was an amount that was statutorily driven, and it was not based on any of the actuarial assumptions. And that was among the reasons that the funds got into the situation in the first place.
Now, one of the more positive aspects here is that the city did pass some tax increases that are being phased in over time to help with that contribution. And even so, there's still a pretty sizable gap that remains, and there's a ramp up that's required in terms of funding over the next several years to 2023. So I'm just trying to get from you some thoughts about how you approached all that, because you basically took some of those assumptions and put that into your modeling.
Yeah, we did it in 3 steps. So the first step we did is we built models that incorporated the pension fund's actuarial characteristics. Then we incorporated the requirements of the new pension law. And then basically, for those that hadn't yet been projected, we projected 2 of the funds that projections hadn't been developed yet. And then what we did is looked at all of the things the city has already done to raise money against each of those 4 funds.
Right.
We looked at those projections over the next 8 years. We looked at many years, but we looked at, in particular at the next 8 years, because that's where the big ramps are most significant. And then we basically subtracted one sum from the other in each year. What is the total amount the city is likely to be required to contribute based upon all the assumptions and the new state laws, minus the amount that the city has already identified as funds being raised. And that gap is what we pointed out in the report as what the city is going to need to raise.
Now, you're fairly optimistic about the assessed value growth and what might be required in terms of property taxes. Clearly they've already taken action, but I guess the supposition is that they're going to take action again in the future, and that it's likely to be property tax based. Just want to discuss that a little bit?
Sure. Yeah, we actually, slightly different than that. We looked at what the city has done to date, and what we noticed is that of the amounts that the city has already raised to begin this ramp up, about 65% came from property taxes, and about 35%, close to 40%, depending on the fund, came from non-property tax sources.
Right.
So in our projections, we carried forward that ratio. We made assumptions based upon their prior practices, and assumed that of the gap that we identified, roughly 65% would come from property taxes and 35% would come from other sources. Okay. And then we modeled those projections.
Well, you do state here that actual property tax rate increases will likely be much less than many analysts project.
Yeah.
Again, the thinking there, I believe you were assuming about 3% AV growth?
Yeah, so that point though is a separate topic. Let me take that into 2 parts.
Well, we always take, rate times the AV equals, right?
The main reason that we made the observation about tax rate increases is that we've seen discussions in the market that assume that the city would have to fund a 20 or 30-year ramp up to get to 100% funding, and they would have to do it by passing taxes immediately. In other words, what's the amount that they would have to pay if they were to do a scenario where they were amortizing their unfunded pension liabilities over 30 years? That's a much different number than what is in the law or what is required. And what we saw several analyses and presentations do is look at that number, which is a hypothetical number, which isn't required and much larger than the city's actual requirements. And we saw instances where folks were saying, if they needed to raise that much money, that's an X% increase in the property taxes that they're collecting, and therefore the property tax rate is going to go up by that X%.
Well, we know that they don't have to go exactly according to formula.
Right. So what we did is basically say, if the city follows this ramp up, and if during that ramp up period property tax base was growing at somewhere between 1.5% or 3%, we ran both scenarios.
Right, like a high, medium, low kind of.
Yeah. What would be the net impact on the individual household?
Right.
And that's where you see the tax rates that are gradually introduced over time as the tax base is growing are much smaller increases than if you said, tomorrow, let's assume that you have to start funding this on a 20-year amortization schedule.
Right. Well, you do compare with other cities in New York and Philadelphia. You take the combined burden of pensions and debt.
Yeah.
And clearly New York and Philly are higher, but Chicago is slightly higher than the rest of the Midwest, it seems.
Yeah. I think in a lot of those ratios, you see New York and Chicago are sort of alone in the size of the burden.
Right.
And Chicago's is somewhat greater. And we actually made an adjustment because right now the way the city of Chicago reports, they're essentially reporting based on a GASB penalty associated with their not having yet adopted the new law that's going to help them shore up the two of the funds.
Right. Well, there's
but
nothing...
even after that, it was still Chicago and New York are outliers even after you adjust for that.
I mean, the 30-year is a GASB sort of recommendation, if you will. I mean,
They're careful not to say recommendation.
Well,
but it's a guideline.
Guideline, okay. Thank you. Guideline. And, some places clearly don't adhere to the 30 years. It's not just Chicago, it's multiple places.
Yeah. New York City's been on a long process of getting to full funding. They're obviously much more highly funded than Chicago, but they're still quite a ways away from 100%.
Well, clearly I grew up in a time in the industry when, pension funding, hardly anybody focused on it, and then everybody started focusing on it. And now I frankly, I think some of your competitors have really focused on it as a factor versus other factors.
Right.
It seems to be giving more weight to it in the process.
Yeah. So our observation is that focus is appropriate, but it's necessary to take the next step. If you just look at the ratio and stop there instead of saying, what does that ratio cause the need to be? What is the annual requirement? How is that annual requirement going to be paid for? What is the impact on that annual requirement on other factors such as the budget, tax rates, affordability of households? And we think that's the exercise that we feel is more important and laid out in the report for Chicago.
Okay. Have you contemplated taking this to other cities beyond Chicago, the cities that you're evaluating? I mean, is this approach going to be kind of a standard Kroll kind of approach?
Interestingly, our methodology has always said that we view pension obligations as slightly different in important ways from direct debt obligations. So in that regard, we're not doing anything that different here, and we'll continue to do it. I think the notion of boiling down this net pension liability ratio into what is the annual requirement and how does that impact budget is also something that we've done elsewhere. But in Chicago, I think we did a deeper dive into that next question that was being asked frequently in the marketplace: is how are they going to pay for this?
Right. Well, we tend to talk in abstract terms here, but again, in one of your tables, figure 13, you talk about the city's pension needs, and in 2023, the actual dollars required are $885 million. I mean, it's a pretty big number.
Yeah, that's a big number.
But you're still feeling fairly comfortable that given the level of taxation and given the level of incomes and how fast they're growing, that it's still affordable.
Yeah, we show in later tables what the tax rate increases would. I mean, that's a big number, but you have to remember how large of a tax base you're drawing from and all the other resources.
It's very large, yeah.
And what we show is that the tax rate increase gradually implemented, even assuming 1.5% growth in the tax base as opposed to 3%, results in a burden on the typical household that's significant, but not dramatically different than what it is today, nor dramatically different than other major cities.
Well, one point you do make is that between now and 2023, there's another revaluation in 2019.
Yeah.
And I guess they don't really forecast the numbers for that yet. It's too early.
No, and we don't even have the 2016
Final.
full market value yet.
Yeah.
We have the assessed value, and we've covered this area for many years, I'm sure, but Cook County is all localities are different in how they calculate tax base, assessed value, and tax rates. Cook County is particularly different. So we do know the assessed value and the equalized value numbers, but we don't have the full market value data yet.
Well, it's going to take some time. Are there other things that we should be talking about here and considering in your analysis here?
Yeah, I think one issue that is often talked about, I think particularly in the context of GASB and some of the things that are published elsewhere, is this fear of what happens if investment returns are lower than the actuarial assumptions. And I think in some cases the actuarial assumptions remain quite high. There's some cities and municipalities that are still above 8%, which is maybe going to happen this year, but not always.
Well, we had some good returns last year, but it's the first time in quite some time.
Exactly. So I think what we did is sort of put a face to that problem by actually modeling out the 4 pension funds and showing what a 1% difference would mean to the city. In other words, if they're assuming 7.5% and it's a 6.5% return, and that 6.5% return is sustained over time, we converted that into, rather than a fear and a concern, we converted it into a number. That number actually, with the new state pension law, translates into a $140 million additional amount the city would have to pony up in a scenario where their investment returns were consistently below their 7.5% target.
Right, but again, on that, we tend to focus too much on year to year, but you're supposed to take the long-term view on that.
Which is why we in the report say that if this was sustained over a long period of time, it's not clear that that would be an automatic next year you have to increase the amount. But I believe over the long term, the funds are getting more conservative in what their discount rate and investment return assumptions are going to be, and that's prudent in the context of the size of the ramp up that they have.
Right. And then in this discussion, it always segues to OPEB. And I was reading in your report that the OPEB scenario for the city here is looking a little better, that they're making some changes.
Yeah. The city of Chicago is somewhat unique amongst large cities in that OPEB is well under control based upon prior decisions over many years, and there's one piece of litigation that's still outstanding, but their OPEB responsibilities are really modest, above and beyond what they contribute to OPEB through their contributions to the pension funds.
Right. It's just in Illinois in general, not just to talk about Chicago, it's so hard to change any pension aspects. You have any inkling about what might develop there over time? I mean, I'm not saying you have an answer that anybody else has.
No,
but,
it's really remarkable, right? So you had laws that were counterintuitive for a long time, and they couldn't change them. Luckily, with this recent 2018 budget, the city was able to get legislative leaders to include the change in law that allowed them to, shockingly, increase the amount of contributions they can make to the pension funds. Prior to that, they were inhibited in doing so. So no, I think the city and the mayor said this last week. They took a run at it. They tried to make changes in some of the pension benefits that were more significant, and they did so with the support of much of the leadership of labor. Not all of it, but some of it. But the changes were ruled unconstitutional. Mm-hmm. So absent, we point this out in the report, absent some state leadership somewhere standing up and saying, we should try to amend the Constitution. It seems that Chicago and other municipalities in Illinois are going to have to go forward with the pension assumptions that are embedded today.
Mm-hmm. One other aspect of this is, although of course you're bullish on Chicago's ability to service the pensions.
Bullish at a BBB plus. It is still a BBB plus credit,
right,
which is much lower than you would expect a city to be in the context of this kind of economy and demographic.
Okay, I take back bullish. How about positive?
Confident they can afford these obligations.
But the other aspect of this is, as you duly note in your report, is the overlapping entities.
Yeah.
And clearly CPS is still hanging in the balance to a degree, and of course, one entity doesn't really control all the other entities.
Right.
I mean, except for to the extent the state has something to say about everything, but the other entities kind of pursue their own goals. And yet you still seem fairly optimistic about that as well. Can you just explain that?
Sure. And we obviously agree that this level of stress on the regional economy is significant. But we went beyond that recognition to sort of unbundle the problems and tried to quantify them. So we looked at each of the overlapping entities, their ongoing debt and pension obligations, some of which, like in the case of CPS in Cook County, are ramping up significantly over the next 5 to 10 years at the same time that the city's pension obligations are ramping up. So rather than just stopping there and saying, wow, this is a big problem, we sort of unbundled it and quantified it and tried to project what those annual obligations would be and looked at how each of the entities are planning to pay for it. In the case of Cook County, as you know, they have the sales tax rate increase, and that's a significant contributor to their ability to meet the increase in the pension obligations. And in the case of CPS, we modeled several scenarios, most important of which is we assume that somehow, perhaps indirectly, perhaps by a special levy, perhaps in some other way, that the property tax base ultimately gets tapped to plug the CPS operating pension and debt increases that are needed over the next 5 to 8 years. And all of that is baked into these projections that show what the tax rate burden would be and what the household tax burden would be. So I guess our approach was, look, we are concerned. I think everyone has a right to be concerned about the magnitude of these increased obligations, but we took it a step further and tried to quantify it in ways and then stress those scenarios to come up with our conclusion.
Well, that sounds like a commendable approach. I was just hunting around for the full market value of Chicago. It's over $250 billion. So when you start to talk about, 800 million plus, maybe it's fairly manageable is what you're coming down to.
Fairly manageable, but in a very sensitive environment. All cities are sensitive to property tax increases. I think Chicago for many years has been particularly sensitive.
Right.
And I think they remain somewhat sensitive. And absent that issue, if the city really needed to make this conversion very quickly, they clearly have the tax base upon which to draw from.
Well, the income taxes too are generally lower in Illinois, but even if they're poised to go upwards a bit. But.
Well, yeah, the income tax increase that just happened was a big driver of the total tax burdens that we calculated on households and businesses. It's the single largest driver. It's the largest driver in the corporate total tax burden, and it is clearly the most sensitive driver in the household total tax burden,
Right.
more so than property taxes. And that tax increase occurred as we were working on this report, and so we saw the changes in the numbers in those increases. So yes, if the state needed to increase income taxes even further, I think that would create even heightened sensitivity and resistance to the other things that need to be done.
All right. Well, thanks for coming in, and we hope to hear more about pensions from Kroll.
Thank you.
And you.